You recently cut your price target for the S&P to 2890 from 3000. Why? Was that because of some of these risks?
We track 6 drivers of the U.S. equity market. At the start of the year, we had 4 that were positive. It's down to 2. And, specifically some of the clouds we're seeing are actually gathering in Washington. We think, the tweet that we had this morning on oil prices, that's exactly what we think we're going to get more of throughout the rest of the year. It's just a more uncertain economic policy environment coming out of D.C. that's going to keep things more volatile. We said basically we're still bullish, but we do think investors need to curb their enthusiasm just a little bit because of some of these gathering clouds.
What are the 2 indicators that you do see as positive, and what are the other 4 that have sort of started to get softer?
So the 2 that are still positive are deal and cash deployment and revisions or earnings trends. So the D and the R in our drivers framework. And basically with deals and cash deployment, we think buybacks are going to be robust. We think you're going to get more CapEx spend, debt pay down. Those are all really good things. We also think earnings are going to be very strong this year. You're starting to see that come through, and I know there was a lot of optimism that was built up coming into this reporting season, but it is playing out, and we think that's going to be a strong underpinning this year. The 2 negatives that we really see are investor sentiment and positioning. There was crowding in the U.S. to start the year. That is unwinding. It's probably not done yet. The one that's changed from positive to negative since January is retail money flows. And if you look back at the January and February data, we had very strong ETF inflows coming into the market. That stopped in February and March, and now we're seeing net outflows again from the U.S. It's very unusual to get that this early in the year.
Interesting. So, David, if that's true that you see more volatility and we're sort of seeing some indicators roll over, how do you hedge yourself?
Well, I think you have to be careful because, our view, similar to what Lori was describing, is we think there's good upward pressure in the market, but we just don't think it can be a runaway market. We think we're a bit more range-bound. We'll claw our way higher. I don't think there's any massive disconnect between where forward earnings estimates are and where the stock market is. I think we've been reasonably priced in. So we think the market will have upward pressure, but it's not a runaway market. So we're sort of in kind of this low beta world. Well, that might argue for being defensive, but many of the defensive sectors are somewhat expensive. So we would lean towards things that we can try to find that are cheap. There's not a lot out there that's cheap, but we like things like banks within financials. There are pockets of value where you can be a bit lower beta. There are strategies. You can hedge with options. You can do a lot of different things. But what I don't think you can do is just buy the classically defensive sectors, which also tend to be interest rate sensitive, and that worries us a little bit.